Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we're focusing our analysis on Alpine Income Property Trust, Inc. That's ticker symbol PINE. We're going to be breaking down their Q3 2025 earnings data, which they filed back on October 23, 2025.
And our mission today is pretty robust. We're here to really investigate, debate, and, synthesize what the financials and what management is telling us. We have to look beyond the surface, especially at this strategic shift they're making, this aggressive expansion into commercial loans.
Right. And what that means for the REIT's risk profile and its outlook.
Exactly.
Because the immediate paradox in PINE's results is really where you have to start. I mean, on one hand, the company delivered solid year-over-year growth in AFFO-adjusted funds from operations.
Right. That's the cash flow metric that all net lease investors watch for dividend safety.
Precisely. And they did that alongside some major high-yield investment activity. But then, you pivot to the traditional GAAP figures, the generally accepted accounting principles.
And it's a completely different story.
Completely different story. PINE reported a significant GAAP net loss for the quarter.
It's the classic REIT accounting puzzle, but this one feels magnified. AFFO per share was up 4.5%, which signals real operational strength. But that traditional bottom line, net income, was underwater by, $1.4 million?
Mm-hmm.
That's more than just a blip. It suggests there's a deep strategic, house cleaning process going on. It feels like management is sacrificing that short-term GAAP income for what they're claiming is long-term portfolio quality.
And that's the core question we have to answer. We have to ruthlessly determine if this GAAP loss is truly temporary, just a strategic cost tied to selling off assets,
right,
or if it's masking something deeper, more fundamental.
Right.
And to do that, we have to start with the raw data.
Mm-hmm.
We need to see where the revenue's coming from, and then, crucially, where all the expenses, especially those non-cash ones, just erase the profit.
Okay, let's start at the top line then. That usually gives us the first indicator of how their investment strategy is playing out. Total revenue for Q3 2025 hit $14.563 million.
Right, and that's a measurable 8.0% increase year over year compared to Q3 2024. A really healthy climb, especially in this environment.
But we need to break that down because where that growth is coming from tells the whole story about PINE's transformation, doesn't it?
It really does.
Yeah.
So lease income, that's the stable long-term revenue for any net lease REIT. That part contributed $12.122 million.
Okay, so the vast majority of it.
The majority, but the year-over-year increase there was only a modest 3.4%. Management says this is because property acquisitions outpaced dispositions, which is fair, but that low growth rate shows you the core rental business is kind of running in place. It's only expanding slightly.
So the actual engine of growth, the part of the business that validates this whole strategic shift they're making, has to be the interest income from commercial loans and investments.
Yeah, and it is. That line item surged to $2.32 Lowe million for the quarter. That is a massive 39.5% increase year over year. That percentage, it's astonishing, and it should immediately signal to you, the listener, that PINE is rapidly changing from just a pure-play net lease REIT into something else.
It's a hybrid now, a real estate finance and a property ownership company.
Exactly. And this steep rise reflects two things. First, the bigger loan portfolio, which is now over $100 million, and second, the extremely high-weighted average yields they're getting. We're talking close to 10%.
So this is proof that their barbell model is actually paying off on the income statement. It's more than making up for the, modest growth in rent.
It is. Now, other revenue was small, pretty flat, at about $0.1 million. That's mostly fees from their revenue sharing agreement with their external manager, CTO Realty Growth. It's a footnote, really.
Right, but it confirms that ongoing relationship. Okay, so now for the number that really jumps out. The headline, net loss. PINE reported a net loss for Q3 2025 of negative $1.423 million.
And you have to compare that to a solid net income of $3.354 million just a year ago in Q3 2024.
That isn't just a swing. That's a 142.4% negative reversal. It's huge. And the per-share GAAP measure, the EPS, was a loss of 9 cents.
So you've got almost 8% revenue growth, but that growth was just completely overwhelmed by costs somewhere else.
Which means we have to go straight to the cost side to figure out where this GAAP income went, and more importantly, was it intentional?
The second you see a REIT making a strategic shift that causes a GAAP loss, you immediately look for non-cash charges. And here, the main drag can be pinned on two things: the provision for impairment and the result from asset sales.
Okay, let's start with impairment. This seems like the clearest sign of management cleaning house. The provision for impairment jumped to a staggering $1.915 million in Q3.
Yeah, and that's a 353.8% increase from just $422,000 a year before. When a REIT takes an impairment, it means they've decided the value of an asset on their books is higher than what they could actually sell it for.
So this huge non-cash charge is really a direct consequence of their plan to aggressively sell off non-core, lower credit assets. They're basically deciding to take the financial pain right now.
They are. And the specific properties they wrote down, because they were marked as held for sale, included convenience stores, that former Party City property, an at-home store, the Century Theater Center, and 3 Walgreens locations.
So these are all properties where maybe the tenant's credit has weakened, or the property's vacant, or the market's just shifted, making their old book value totally unrealistic.
Right. So by impairing them, Pine sets a lower, more realistic price and gets them ready to sell. But that move cost them $1.9 million in paper losses this quarter.
And that leads right into the second major factor you mentioned, asset sales volatility. In Q3 of this year, Pine recorded a tiny loss of about $46,000 on asset sales.
But then look at the same quarter last year. In Q3 2024, they had a massive gain of $3.426 million.
Okay, there's the statistical swing right there. You combine a $1.5 million jump in impairment plus the almost $3.5 million reversal from a big gain to a small loss on dispositions.
That's about $5 million of negative pressure on net income right there.
So given the net loss was only $1.4 million, this volatility from selling properties completely explains the swing. It makes management's claim that this GAAP loss is strategic feel much more credible. It's all driven by the mechanics of selling properties for less than what they were valued at years ago.
Right. And moving to their recurring costs, there was actually a positive note on efficiency. General and administrative expenses, G&A, that actually decreased to $1.695 million.
Down 8.0%. That's pretty good.
It is. And management said it was mainly due to lower corporate legal and consulting fees. So that's a real reduction in overhead, which is important if you're using an external manager.
Okay, but the cost of capital, their debt, that's clearly going the wrong way. Interest expense jumped to $3.91 million. That's a 23.5% increase from last year.
And that's a direct result of two things. First, they have a higher average balance on their credit facility because they're funding all these acquisitions and loans. And second, the fixed interest rate on their 2027 term loan went up late last year.
So this is the critical trade-off Pine is making, isn't it? They're willing to take on higher interest expense, driven by more leverage, because they're putting that money into loans that yield 10% or more.
Exactly. The cost of their debt is up, but the yield on their new assets is up even more. That spread is where all their profit is coming from now.
So the GAAP numbers are, ugly. They're dominated by these strategic write-downs and the pain of selling off assets. So let's shift completely to the cash flow reality that management says is what really matters, the AFFO.
This is the complete counterpoint. Funds from operations, FFO, and adjusted FFO, which strips out all that non-cash stuff like impairment. Both of those came in at $2.46 per diluted share for the quarter.
And that $1.46 AFFO number, that is the crucial metric. Because despite all the noise and the heavy GAAP losses from restructuring the portfolio, AFFO still grew by 4.5% year over year.
Right, which proves that the underlying core operations, the rental income plus that exploding interest income from the loans, are generating reliable, growing cash flow.
And if you look at the year-to-date numbers, it confirms this trend. Year-to-date, FFO and AFFO were both $1.34 per share, with the YTD AFFO up 3.1% over last year.
So you've got this steady growth, even while they're in the middle of selling off all these properties. It's pretty compelling evidence that their capital allocation strategy is working, at least on a cash flow basis.
And this strong AFFO is what guarantees the dividend. The quarterly dividend they paid was $0.285 per share. The key number here is the AFFO payout ratio for Q3, which was about 62%.
Let's just pause there for a second and really emphasize why 62% coverage is so important. When you look at Pine's peers in the net lease space, the average AFFO payout ratio is closer to 71%.
So that 62% means Pine gets to keep almost 40 cents of every dollar of cash flow after paying its dividend.
Exactly. And that retained capital is essentially cheap internal equity that's funding their expansion into that high-yield loan pipeline. It's the low-cost fuel for this whole strategic transformation they're undergoing.
And management was quick to point that out. They've raised the dividend by 42.5% since the first quarter of 2020. That's a huge signal of confidence. They're basically telling investors, ignore the short-term accounting noise from dispositions, the cash flow is real and it's growing.
Okay, so we've established the financial dynamics, painful GAAP loss, but it's offset by surging AFFO. Now we have to dig into the physical portfolio, and this controversial barbell strategy Pine is pursuing. It's trying to marry two very different business models.
Right. So as of the end of Q3, Pine's core property portfolio had 128 properties, covering about 4.1 million square feet across 34 states.
And the fundamental health of that net lease portfolio is still really impressive. Occupancy is rock solid at about 99.4%.
And to maintain that while you're actively pruning assets is crucial.
It is. The weighted average remaining lease term, or WALT, that stood at 8.7 years, which gives them great revenue visibility well into the 2030s.
The real challenge, and where the stability side of the barbell comes from, is credit quality. Right now, 48% of their annualized base rent comes from investment-grade rated tenants.
And that 48% is the anchor. It's the stable, lower-yield, long-term contractual revenue that's supposed to act as the counterweight to the higher-risk, high-yield loan portfolio.
And they have some diversification, too, which helps buffer against risk in any one sector. Sporting goods is the largest at 17% of rent, then home improvement at 15%, which has been very resilient, and dollar stores at 12%.
Geographically, they're still concentrated in Florida, which is 13% of their rent, followed by New Jersey and Texas.
So let's look at their investment activity, because that shows a laser focus on improving the quality of the property side of that barbell. I mean, the single most important acquisition was buying 2 ground-leased Lowe's properties for $21.1 million.
That was a premium move. Ground leases are extremely attractive. They carry much lower risk. They bought them at a 6% initial cap rate with a strong WALT of 11.6 years. And critically, this one deal immediately made Lowe's Pine's largest tenant by rent.
Wow, so they actually surpassed DIC's Sporting Goods, who's now number 2.
They did. This is a massive, deliberate shift toward high-quality, investment-grade tenants that directly counters the fact that they're selling off weaker credit assets.
And that high-quality inflow is paired with these aggressive disposition targets. Management confirmed they plan to keep trimming back properties where the credit has weakened or the market is uncertain so they can reinvest that money into better opportunities.
And they were very explicit about the targets. Some of their 8 remaining Walgreens properties, since Walgreens lost its investment-grade rating dollar stores, and other generic properties like Tractor Supply or Advance Auto Parts.
And year-to-date, they had already sold 11 properties for $34.3 million. So it's this activity that's causing all the gap pain, but it's also providing the critical equity they need for their higher-yielding strategies.
You know, there was an interesting qualitative insight about their coastal properties. They mentioned the recovery of their beachside properties that were damaged by a hurricane back in 2024.
Right, I saw that. Management actually said that sales after the hurricane were higher than before it.
It's a fascinating, almost paradoxical result, isn't it? The reason is purely competitive. The storm damage caused some of their competitors to just fail to reopen.
So there's less competition.
Exactly, less local competition, which drove higher traffic and, critically, higher rent coverage for Pine's tenants who were able to weather the storm. It suggests that in some very desirable markets, disaster risk can almost become a competitive advantage if your tenants are capitalized well enough.
Okay, let's pivot to the other side of the barbell. The dynamic, high-growth, high-yield segment that is the core differentiator for Pine. Commercial loans and investments.
Right, and management sees this as balancing the risk. You get stability from your investment-grade net lease properties, and you get growth and outsized yields from secured lending.
The rationale behind this is crucial for investors to understand. These loans aren't just unsecured debt, right? They're always secured by the underlying real estate.
Always. Which provides a degree of risk mitigation. And perhaps most importantly, from a strategic angle, these deals often give Pine a right of first offer, a ROFO, or an option to acquire the property itself.
So it's an investment pipeline. It's not just a debt play.
It's optionality. And the pace of deployment here is aggressive. In Q3 alone, Pine committed $28.6 million in new loan activity.
At a really eye-watering weighted average initial yield of 10.6%.
It's huge. And year-to-date through Q3, they originated $74.8 million in loan commitments at a 9.9% weighted average initial cash yield.
That's a substantial amount of money for a REIT of Pine's size.
It is. As of September 30th, the total value of this segment was $102.772 million. And the portfolio is made up of 5 construction loans, which are inherently higher risk, 6 mortgage notes, and 3 sale-leaseback deals accounted for as financing. The mix shows they're definitely moving into riskier parts of the capital stack.
And the best example they gave, the one that really illustrates their risk appetite, is that Austin, Texas luxury residential development loan. They did that one just after the quarter ended, on October 15th. This one is really illustrative of their whole strategy.
Right. The commitment is secured by a luxury residential development in Austin. It's a phased deal. Phase 1 is up to $29.5 million, and Pine funded $14.1 million that right at closing. Phase 2 is for up to another $31.8 million.
I mean, this is a major commitment of capital. It rivals their property acquisitions.
It does. And now let's talk about the yield, because this is where you can see the risk being priced in. The loan initially bears interest at an astronomical 17.0%.
17%. But there's a critical nuance here. That 17.0% includes a 4.0% paid-in-kind or PIK interest component for the full 36-month term.
We have to explain PIK clearly. Paid-in-kind interest is non-cash interest. So instead of the borrower writing Pine a check for that 4% portion, that amount gets capitalized. It's added back to the outstanding loan balance.
So Pine is only getting 13% in cash in the short term, but the loan balance is actually growing by 4% a year. It delays the cash, but it increases the total return if the loan is successfully repaid.
Exactly. It helps the borrower's near-term liquidity, but it means Pine's stated 17% yield is highly dependent on the borrower successfully finishing the project and repaying all the accrued principal and PIK interest.
And that dependence on success is why the risk mitigation steps they took are so important. Management knew they had to adjust the perceived risk of a residential development loan.
Yeah, they confirmed they're not coming in on raw land. They're entering at a late stage, at the finish line of delivering lots, as they put it. The entitlements for both phases were already secured.
Okay, so that takes a lot of the unpredictable regulatory risk off the table.
It does. Furthermore, they estimated the loan-to-value, the LTV, is in the low 70s on a discount NPV basis, which gives them a pretty comfortable equity cushion. But here's the sophisticated capital management part. Pine expects to sell a senior tranche, or A-note, of this big Austin loan in early 2026.
Okay, so that's standard practice in structured finance. By selling off the senior piece, they offload some of the risk, they free up their capital faster, and they get to keep the higher yield subordinated B-note or mezzanine piece.
Exactly. It lets them monetize their underwriting expertise and recycle capital much faster.
Okay, so deploying nearly $75 million into high-yield loans, plus buying those Lowe's properties, that requires aggressive use of the balance sheet. And this brings us right to a key debate point. Leverage.
Right. Pine is currently managing about $358.5 million in total debt, with a weighted average interest rate of a pretty competitive 4.50%. The hedging they're doing is key to locking that in.
The real point of scrutiny, though, is their leverage ratio. Net debt to pro forma adjusted EBITDA was 7.7x at the end of the quarter. Now, if you're a traditional conservative net lease REIT investor, that number is a red flag.
Oh, for sure. Most conservative peers try to operate in the 5.0x to 6.5x range.
So this higher leverage, 7.7x, it's not necessarily a sign of distress, but it's a direct reflection of their strategic choice, isn't it?
It is. The barbell strategy forces Pine to operate outside that conservative comfort zone. And management justifies this higher risk profile by pointing to the dramatically higher yields from the loan segment. They're arguing the increased returns outweigh the moderate increase in leverage risk.
That is a tough argument to swallow in a potential recession. It means Pine has less room to absorb unexpected losses in that loan portfolio compared to its peers. But let's look at the debt structure itself.
True balance between facilities. They've got $158.5 million outstanding on their credit facility, which matures in January 2027. They have a $100 million term loan due in May 2026, and another $100 million term loan due in January 2027.
So the maturity timeline is concentrated in the near term. They have a $100 million wall in 2026 and a combined $258.5 million due in 2027.
Right. Managing that May 2026 term loan maturity will be the single most critical financing event for them next year. It's going to require either a major refinancing or a huge capital recycling effort.
So given those maturities and their aggressive investment pipeline, liquidity management has to be paramount. At quarter end, Pine reported total liquidity of $61 million.
And that consisted of a very modest cash balance of just over $1 million and about $60 million available on their credit facility.
A sub-$2 million cash balance is tight. It really shows they're committed to keeping capital deployed. But management added a key caveat, didn't they? They said their potential liquidity could expand to over $90 million through in-place bank commitments.
They did. which acts as a potential safety buffer, but it assumes they can execute on their property acquisition pipeline.
And their funding strategy for future commitments seems highly reliant on recycling capital to avoid having to raise equity in the short term.
Right. They anticipate funding the pipeline using three key sources: continued asset sales, maturing loan proceeds. They expect about $21 million in loan proceeds to mature in 2026, and, critically, selling senior loan tranches, like that A note on the Austin loan.
That reliance on the $21 million in 2026 loan maturities is so important. If those loans perform and pay back on time, it significantly de-risks that $100 million term loan maturity.
It does. And we also have to remember their committed pipeline. They still have $17.2 million in unfunded loan commitments, plus another million for capital improvements. They need continuous liquidity to meet those obligations.
And given that so much of their debt floats based on SOFR, the secured overnight financing rate, they're using interest rate swaps pretty aggressively to hedge that risk, right?
They are. It's prudent in this rate environment. They've comprehensively hedged their term loans. The entire $100 million 2026 term loan is fixed at a SOFR of 2.05% plus spread.
Okay.
And the $100 million 2027 term loan is also hedged, though it's split. $80 million is fixed at 1.61% OFR, and the other $20 million is fixed at 3.84% OFR.
And what about the credit facility?
They've hedged $100 million of the balance there, too. It's split between two swaps, one at 3.21% its OFR and the other at 3.43% OFR.
So the big implication here is that Pine has basically fixed its benchmark debt cost at historical lows across about $300 million of its debt.
That's right. They're largely insulated from immediate Fed policy changes or unexpected SOFR spikes. That 4.50% weighted average interest rate they report is fixed, which provides substantial stability for the next 18 to 24 months. And that's critical when your strategy involves deploying highly leveraged capital into high-yield assets.
Okay, so beyond the hard numbers, the commentary from management and some of the structural details give us the context we need to really understand Pine's operational risks and alignment.
Right. And first up is the fact that Pine is externally managed by a subsidiary of CTO Realty Growth. Now, that relationship sometimes draws scrutiny, but here it actually provides a strong element of alignment.
Because CTO owns a huge chunk of Pine.
A very significant chunk, 16.1% of Pine's outstanding equity. That's composed of over 1 million OP units and over 1 million shares of common stock.
And that substantial ownership is key. It means CTO's interests are tightly aligned with Pine's stock performance and dividend, which reduces the risk of management making self-serving decisions.
And the external structure also gives them economies of scale. They get to use the 42-member CTO team without Pine having to bear the full G&A expense of a self-managed structure.
The management agreement is up for renewal soon, though, isn't it?
It is. It expires January 31st, 2026, with successive one-year renewals. Any termination or renegotiation of that would be a major operational event.
And Pine also benefits from that right of first offer, the RFO agreement, with CTO on single-tenant properties. That's been huge for them, leading to big acquisitions like the CMBS portfolio deals.
It gives them a proprietary vetted deal flow that a lot of other net lease REITs just don't have.
Okay, this next section requires some critical attention because it reveals a significant strategic setback that management is trying to overcome with this whole disposition program.
Right. We talked about their strategic shift toward high credit tenants like Lowe's, but the materials also reveal that the percentage of their rent from credit-rated tenants actually dropped precipitously. It went from 81% down to 66%.
Wow, that is a 15-point drop in credit quality concentration. That's a massive deterioration.
It is, and management can't just blame this on their acquisition mix. This drop is largely because specific existing tenants, namely Walgreens and At Home, lost their investment-grade credit ratings altogether during the period.
So this highlights a fundamental risk. They were holding on to older assets that experienced a really material credit deterioration, which is what's forcing this accelerated disposition strategy we're seeing play out now.
Exactly. That sharp decline from 81% to 66% means Pine's revenue is now reliant on a higher proportion of non-rated regional or local tenants. The Lowe's deal helps, but it doesn't fully mitigate the loss of credit-rated revenue from the legacy portfolio.
It really underscores why the disposition and impairment charges were so heavy this quarter. They're literally rushing to shed assets that are no longer classified as high quality.
And if we revisit the impairment provision, there was a small but telling detail. A $100,000 provision for credit losses, a CECL reserve related specifically to the commercial loans.
Right, so they haven't had any losses yet, but they're still setting money aside.
They have to. The TECL reserve forces them to anticipate potential losses based on macro trends, even if the portfolio is performing perfectly right now.
Finally, let's explicitly link the short-term gap gain to the long-term operational gain. Management gave some clear targets for expected expense relief from their disposition strategy. For instance, selling that Reno Theater property removes about $400,000 in annual expenses.
Right. And selling the remaining vacant former Party City property would remove another nearly $400,000 annually.
So that $1.9 million gap write-down this quarter is effectively buying Pine $800,000 in annual recurring G&A and operating expense savings.
That trade-off, a one-time paper loss for ongoing operating efficiency, makes their claim of a strategic loss highly defensible.
Okay, finally, let's just quickly cover a legislative update that provides some context for Pine as a REIT. This is the One Big Beautiful Bill Act, or OBBA, signed back on July 4th, 2025.
Right. This act isn't going to change Pine's stock price tomorrow, but it confirms a critical long-term trend of greater regulatory flexibility for REITs. Three changes are pretty relevant. First, it increases the taxable REIT subsidiary, or TRS, asset test limit from 20% to 25%.
Which means Pine and other REITs get more flexibility in how they house non-real estate assets or activities. And given Pine's growing and complex commercial loan segment, that increased flexibility is a net positive for them.
Second, the OBA makes the 20% deduction for qualified REIT dividends permanent for individual investors. That provides long-term certainty for retail investors and helps keep REIT dividends attractive.
And third, the Act restored the exclusion of depreciation and amortization when calculating the net interest expense deduction limitation. That's a technical change, but it's beneficial. It generally increases the available deduction and improves the after-tax economics for REITs with a lot of debt, like Pine.
So, synthesizing everything we've covered, Alpine Income Property Trust successfully executed a strategically volatile Q3 2025 quarter.
Yeah, the narrative is really one of managed duality. They're achieving strong revenue growth and high investment yields, especially from the loan segment, while deliberately taking a GAAP net loss. And that loss was the necessary price for this aggressive portfolio cleanup.
Right. Swapping lower credit assets and vacant properties for investment-grade Lowe's properties and high-yield secured lending commitments.
The strategy is clear. Enhance long-term property quality, shrink their recurring operating expenses, and use this opportunistic lending for high current yields and potential long-term acquisition optionality.
And the dividend coverage is robust, which gives management the latitude to pursue this really complex transition.
The provocative question for you, the investor, it really remains focused on execution risk and capital turnover. I mean, given Pine's accelerated deployment into these high-yield, short-duration commercial loans like that massive Austin commitment, the success of the next 12 to 18 months hinges entirely on capital recycling.
Specifically, how quickly and how reliably will the proceeds from that expected $21 million in 2026 loan maturities be recycled back into new high-yield investments? And what direct impact will the potential sale of the senior tranche, the A note, of that Austin loan have on immediately freeing up liquidity to cover their remaining $17.2 million in unfunded loan commitments? These short-term capital events are what will ultimately define Pine's growth trajectory and, whether the risk associated with that 7.7x leverage actually pays off. With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research, Mindful Markets, Measurable Meaning.